Welcome to METACO Talks, episode 28, and the last of 2021. It's been a great year, and we've talked to some amazing people in the world of decentralized finance. In our discussion today on managing risk in the digital asset economy, we'll have an equally interesting discussion. Then the year we have a guest who literally wrote the rule book on risk, compliance, and best practices for digital assets. Julian Sevillano, who is the managing director of Promontory, has joined us. Julian leads the Promontory's Fintech and digital asset practice and advises financial institutions, Fintech and digital asset firms, and regulatory agencies on implementing risk and compliance strategies. He's got over 20 years in international banking and payments experience. Prior to Promontory, he held various senior leadership positions in risk management, finance, strategy, and treasury at Visa, and has extensive experience with U.S. and international regulators and rating agencies. When it comes to regs, what he doesn't know is probably not worth knowing. Julian, it's great to have you here. Thanks for joining METACO Talks.
Thanks, Seamus. Nice to see you again. It's a pleasure.
Yeah, likewise. So, I think one issue I think we're going to have is there's a lot to talk about. I think your experience is pretty unique, and unfortunately, we only have 30 minutes. But why don't we kick it off? And we talk about you writing legislation. I think that's actually a fact, right? You were very involved in crafting the Wyoming legislation. You work very closely with some of the largest institutions in this market. It'd be great to hear a bit about your background and what you've done in this space.
Sure. Thanks, Seamus. So we've been very fortunate at Promontory. I've been very fortunate to lead a really great team of people that over the last couple of years, we've been head down thinking about regulation and supervision in the context of banking for digital assets activities. We've done some really amazing work and some great projects, and we've got a lot ahead of us. As you alluded to, we wrote the supervisory guidance for the Division of Banking of Wyoming. Those of us that are in the crypto space know that Wyoming was one of the very first states in the U.S., was the first state in the U.S. to basically approve a crypto banking license. And so their speedy banks are allowed to custody digital assets. They're allowed to facilitate trading. They're allowed to facilitate staking, lending, and all other manner of activities, in addition to deposit taking. They're not allowed to lend, actually. They're 100% reserve banks. The Division of Banking basically issued an RFP, which we were fortunate enough to win. And the nature of that RFP was basically to help them write supervisory guidance so that their bank examiners could go into these institutions and understand the nature of the activities that they're performing. So in a traditional bank examiner will go in, look at a bank's loan portfolio, understand kind of how they are underwriting those activities, and determine, okay, they're managing these in a safe and sound manner. In this case, you'd have to go in there and say, how are you managing the private keys? How are you onboarding customers? What sort of due diligence are you doing on them? How are you monitoring transactions? So, as we all know, there's very heightened kind of AML risks. There's heightened information security risks. There's heightened operational risks whenever you're supporting digital assets custody and other related activities. So we had to spend a lot of time. We wrote, I want to say, 750 plus pages of very prescriptive and detailed supervisory guidance on how to comply with AML and sanctions requirements in the context of digital assets custody, what are best practices for managing keys and for managing, and what are the different models? As we all know, there's many different models for managing keys, how to meet fiduciary requirements, when you're performing as a fiduciary on behalf of your customer. And digital assets activities actually present heightened risk as it relates to fiduciary responsibilities, more so than a traditional activity would, because there's more discretion that generally you apply. For example, when you're facilitating a trade of a digital asset on behalf of a customer versus when you're facilitating a trade for a traditional security. And that led us to working extensively with the large banks in the U.S. and internationally that are all lining up to issue to support digital assets custody. But in the context of that, it's a brand new activity. It's a great opportunity for them. But these are very large banks that have very well-established risk and compliance programs, and they need to think about, how do I manage these activities in a safe and sound manner? How do I build risk and compliance programs that my regulators are going to be comfortable with? And outside of Wyoming, there's been a little bit of work that's been done by the OCC in the US, and we'll talk about that in terms of the permissibility. but there's not a lot of supervisory guidance to tell banks how they meet or what the safety and soundness standards actually are. So that's been a fascinating piece of work for us. And I guess the third piece of work that we've been doing is we've been working a lot with the digital asset custodians in the US, the large institutional custodians, helping them become basically banks. And so we've been working closely with Anchorage since the beginning of the year, and we've got several other customers that have either Anchorage is the first US chartered national trust bank and the only one operating right now. We have several others that we're supporting at the state and federal levels as well. So a fascinating amount of work, really interesting. Happy to talk more about our experiences and kind of what we're seeing in the market.
It's a fascinating position because I think most advisory is really about complying with existing rules, but you've started with a blank slate and helped and define what that should be. I mean, how do you come up with what should be best practices, and what are some of those when you're looking at risk and compliance programs?
Yeah, really what we did was if you think about it, what we did when we started this work was we really scoured the world for any and all supervisory guidance, any and all kind of industry white papers, any and all kind of best practices. We tried to reach out to, the ecosystem of digital assets custodians, digital asset service providers. We built pretty strong relationships with a lot of the market surveillance companies, with the transaction monitoring firms, which we still have today. And the idea was to understand kind of what are you doing today, right? Because, a lot of these digital asset custodians, they are, and I'm, speaking to you're an information security company in your DNA. This is what you do. You manage risk in that way. How do we do that in the context of banking and in the context of digital? And that's something that is a translation that needs to occur, right? And then layer on top of that, how do we think about financial crimes compliance in the context of digital assets? And and so a lot of it was very iterative, and it was working directly, with the industry and working directly with the regulators. Interestingly, people always think about risk appetite in the context of in the industry participants, they decide what risk appetite they want to accept. Regulators also decide what risk appetite they want to apply, and they'll either going to hold a very, very high bar, or they're going to hold they're going to set the bar somewhere in the middle that hopefully will enable some form of innovation, while also managing risks and keeping the bad guys out to the extent that you can. So really, when you think about that, we really think about kind of a few key areas of risk that we have to think through. And so, you have to think about the AML and sanctions compliance piece. You have to think about custody operations. You have to think about fiduciary compliance. You have to think about third-party risk management. The crypto world is an ecosystem of service providers that plug and play into each other. And not many of them are actually used to working with banks. So when the bar is so much higher for vendors, for banks, that you really have to think about that as well, and think about how you set that bar, and think about the obligations that banks should have for doing third-party risk management on their vendors. You've got to think about information security, not only in the context of key management, but in the context of the overall program as it is, and how it fits within the different regulatory standards for traditional information security. Understanding that there really isn't a standard at a global level for something like key management. There are lots of best practices, but there's no regulatory prescription that tells you how you should do it. Really, that's a few things. And I guess the last thing I'll point out is payment system risk. And that's an area. Stablecoins, people have been talking a lot about stablecoins lately, and they talk about, how do we think about regulation and how do we think about supervision? Well, there are very well established payment system risk principles internationally by the CPSS, financial market infrastructures, domestically in the US and in several other countries as well. Those principles are perfectly, can be applied to stablecoin networks in terms of how they're managed, how they're designed, the risks that you control around them. And so as part of the work that we did in Wyoming, we also wrote a payment system risk manual specific to stablecoins and specific to e-money tokens. So really fascinating stuff.
Very much so. I was right at the start, there's too much to dive into. So maybe if I pick a couple of things. I mean, you mentioned, I'd like to follow up in a moment about the kind of this risk tolerance approach that you mentioned the regulators need to take. I mean, I think that's super interesting and kind of will inform us when we talk about, different gradations of that globally. But I'd be curious to know when you're engaging, with the regulators, who leads who? How do you connect and communicate with the regulators when there isn't any regulation on these issues, on the best practice you've just been running through?
Yeah, it's a good. So it's a great question, and maybe I'll use an example. So when we work with a client that is going through a supervisory that is applying for for some form of registration or some form of a license, be it a national bank license or a state license or whatever, crypto registrar, there are certain requirements that there's a the good news at Promontory, we have a lot of experience actually helping even traditional firms achieve banking licenses. So when we got the opportunity to work with crypto firms, it was really an extension of what we already kind of have in our DNA. So it's very much a collaborative process where in the case of crypto or digital assets, you have to over communicate in terms of typically when you're applying for some form of license, you create a business plan. And as part of that business plan, you tell the regulators, here's what I plan on doing for the next 3 years. These are the types of clients that I'm going to have. This is the type of services that I'm going to provide. This is the technology that I'm going to rely on. These are the risk and compliance programs that I'm going to establish to support these activities. This is the type of corporate governance that I'm going to have. And hopefully it provides them. And these are the financials, right? This is how much capital I'm going to allocate to this business so that even if things go bad, I've got enough capital to support this business, at least over what they call a de novo period, which is typically about 3 years. Now, in a digital assets firm, you have to over communicate because you can't just say, I'm going to support digital assets custody. Well, how are you going to do that? And what technology will you use? How is it structured? How does it meet certain standards of fiduciary compliance? And so there's a tremendous amount of documentation that needs to go into place. There's what we would do what we do with our customers is we typically have several, before we even start examinations or pre-application examinations, we schedule several working sessions with the regulators, which are, between an hour and 2 hours for different subject matter experts to literally walk them through, this is how we plan, or this is how we do digital assets custody. This is how we facilitate trading. This is how our customer onboarding works. This is how our withdrawal processes work. So literally walking them through, helping them understand in layman's terms, how does a digital asset custodian process a request to withdraw Bitcoin, and how do you do that by humans? What are the humans doing, and who's involved, and what controls are in place, and then what's the technology doing, and how does the technology work with each other to basically make sure that if that withdrawal request comes in, that it's authenticated, it comes from the right person, that we know that we have comfort that it does. And that then it's processed within the bank in a way that doesn't that isn't going to create any errors, and also isn't going to lead to any kind of nefarious activity. And so those are the types of things that we have to walk them through. And if I shift over to the other area of huge focus where we spend a tremendous amount of time with regulators, it's financial crimes compliance. And there we also have to explain to them, why is it that we've built for our clients a financial crimes program that is bespoke and addresses the specific risks that these activities present? And as we know in the digital assets world, there's nothing generic about digital assets custody. Every model is different. Every application, every installation is different. Every instance that every client wants a slightly different, bell and whistle. The client base is different. The customers are different. The risks are different. The transactions are different. And so you really have to, the geographic footprint is different. Institutional versus retail or both, something in the middle. So really we have to explain to them and over explain to them, how is it that we've done that? And we typically start by building a risk assessment so that a regulator can actually see and understand first the risks, and then how am I managing those risks? And how does that meet the safety and standards, or how do we expect that it should meet the safety and standards safety and soundness standards of what regulators are. But it's very much a iterative process. You never want to be teaching a regulator. That's not something that you really want to do or that they appreciate. But you definitely have to help them with education on this new technology and how it applies into in the traditional banking world.
Sounds like a fine balance. Don't teach, but educate. That differentiation. So, I mean, were there any specific challenges? I mean, getting a banking charter. I mean, obviously, as you mentioned, you've done it for Anchorage, and you're working with others. Any specific challenges around going through that process beyond what you've just described in terms of the kind of over-educating around every step?
There were tremendous amount of challenges, and I'll say that my friends at Anchorage are they're true pioneers. They're wonderful people to work with. And they are true pioneers, and I think they very early on understood the benefits of basically aspiring to the highest level of supervisory of supervision in the U.S. at least, right? Because the federal supervision is definitely, and they understood that when if they want to work with large institutions, that's something that you really want to aspire to. And so for them, it's been a massive investment in time and effort. There's been a huge amount of there's been a lot of challenges. I think that the challenges have been in helping, again, going back to working with the regulators in a collaborative way. I will say that in this case, the OCC, which was the entity that has the Office of the Currency of the Comptroller of the U.S. that's granted them the license, they have a tremendous group of career examiners. They're tremendous professionals. They took a very keen interest early on, and they worked really, really hard to quickly get up to speed and learn the technology. There were some challenges. So, one example was, and I was talking about, withdrawals in the context of fiduciary compliance. In the U.S., for example, you have rules which require you to have two human beings, basically, to approve a withdrawal, right? And in some cases, that doesn't fit within the context of how digital assets custody works, because you have very strong logical controls. So we really had to work with our regulators, with those regulators, to help them understand how logical controls in some ways can be stronger than human controls, because they're hard coded, and because it's not just two humans. It's probably a quorum of at least 5 humans on the back end that controls the logic that goes into those controls. So that was one example. A couple of other examples are helping them understand how it is that you perform, how it is that in some cases you have more information and can do a lot more due diligence when you're doing KYC and enhanced due diligence for digital assets custody, when you're actually monitoring transactions. The blockchain gives you a lot more information, depending on the asset that you're looking at, than other traditional assets. So you can actually gather more information, and so there was a little bit of that. I think the other thing to understand is what are whenever we're doing one of these bank licensing engagements, it's not just specific to digital assets. You really have to reach a balance with the regulator to determine what is the appropriate level of staffing, of size, of capital for to support the activities of this specific institution. And everybody wants more capital, everybody wants more resources in order to support that, but you really need to come up to the equilibrium and what's the right level. And that's something that is always a dialogue with a regulator, and is always a conversation. But I think overall, and we had to build a lot, so in a very short period of time. But I think overall, very, very satisfied with the work that we did there, and very privileged to work with, to get the opportunity to work with them and with the regulators on some very groundbreaking stuff. I think that really hopefully sets the standard for those to come.
I imagine you're basically at the forefront of all this change. I mean, just kind of dive into one more question into that U.S. experience. To what degree was it? Brian Brooks was running the OCC for a while, and obviously had a huge, I won't say bias, but it was very open to embracing this industry. And we see that now with this congressional testimony yesterday, which is one of the kind of strongest proponents of the industry on an ongoing basis. To what degree is some of the regulation we see in the US, or the regulators, have been personality driven to, or how far into the fabric has the acceptance of digital assets now reached from a regulator's perspective?
Yeah, I do think it's a little bit personality driven. I think unfortunately it's become slightly political right now, and I think that it's as with unfortunately everything in the U.S. and maybe different parts of the world also.
Yeah.
The different parties tend to pick sides, and because one party picked one side, the other one just automatically picks the other side, and that's not necessarily correct or true. I've been a little disappointed with the recent stance that the OCC has had, in particular, on how on basically on fostering and facilitating innovation. Chairman Sue's made some comments that digital assets firms, if they want to become banks, they now have to also apply to become a bank holding company and also apply for FDIC insurance. And frankly, there's no legal basis for that in any law. It's not something that you can actually just say, do it. You actually have to change laws in Congress to do that if you'd like. So to me, it's a tactic to discourage digital asset firms from becoming banks. And I don't believe that he's speaking unilaterally. They've had this sprint that with all the federal agencies in the U.S., and they've come up with certain position points. And I think that he's speaking on behalf of more broadly, the federal bank regulators specifically. And I think that is unfortunate, because I think it slows down innovation. Now, what it does do, what it will do de facto is it says, digital asset firms, you are technology service providers. You are not going to be regulated entities anymore. The banks are going to be the regulated entities that perform that activity and will contract with you. And for some firms, that's their business plan. That's what they want to do. That's great. But for some other firms, I think it inhibits competition. And that's not something that I think anybody wants. But it's unfortunate that is the net result of what's happening. I don't really think that we'll see any more approvals at the federal level for digital asset firms anytime soon, because meeting bank holding company requirements is an impossible standard for digital asset firms to be. Impossible, first of all, because it's not legal. They actually can't, even if they wanted to apply, they wouldn't be able to. So to me, it's disappointing. I didn't get a chance to actually see Brian's commentary yesterday, but I can only imagine. I know how disappointed he is, and unfortunately, I think that many people, not just in the digital assets industry, but also in supervision and regulation, are disappointed as well. But hopefully, those stances change. I think that what happens is, maybe use another example of federal kind of guidance. The president's working group guidance on stablecoins that came out a few weeks ago. I would give that a C- in terms of a grade. I don't think it was very well. I thought it was done a bit hastily. It wasn't as comprehensive as it should be. It conflated a little bit of the technology in terms of how you manage, or how you actually build stablecoin networks. As I mentioned before, there's pretty well established guidance on payment system risk guidance, and it's not that difficult to apply that to stablecoin networks. And I think that a better approach might have been to actually consult the agencies that have written supervisory guidance on stablecoin networks. And if you look at the sources who they spoke to, they didn't speak to New York State. New York State is supervising several very large stablecoin networks right now. They didn't speak to Wyoming. Wyoming has written a book on stablecoin regulation. So disappointing from the federal agencies. Hopefully that changes. There are several senators, including Senator Lemus from Wyoming, who is very, very outspoken in terms of being an advocate for the agency, for the industry, for digital assets. She and Senator Sinema have been very vocal. They've set up the Financial Innovation Caucus of the U.S. Senate Banking Committee, and the idea is to educate their fellow lawmakers on the benefits of blockchain and on the benefits of responsible innovation and responsible regulation. And so hopefully those efforts, bear fruit and move forward. But I've just been disappointed over the last couple of months, and I know many people in the industry have, unfortunately.
Well, I've been of the same opinion. I was, let's say, positively impressed yesterday with some of the discussions of the congressional discussions, because for once it seemed to be a nonpartisan issue. Both sides were actually coming out much more supportive of potentially things like stablecoins that actually potentially become a proponent for the continued strength of U.S. dollar, dominance of U.S. dollars, as opposed to something that's usurping it. So I think there's some positive signs there anyway on kind of what looked like a dark horizon. But maybe just step back for a second. So I think maybe TAC talked about that risk-based approach regulators are taking potentially in other jurisdictions. We did see last week, I think, even Australia in one of the, I think it was the Treasury speech, basically talked about coming legislation around payments related to cryptocurrency. So they're very much embracing that as what you described. And we've seen other jurisdictions where we operate, places like Singapore, Switzerland, Germany, all allowing innovation to move ahead. And we've seen basically the banks as a result embrace that and moving ahead quite aggressively with initiatives. Which countries, how would you look at the different countries in terms of the risk-based approach to balancing this regulation and innovation?
Yeah, I mean, Switzerland has clearly been a leader, right, for several years now. They've fostered innovation in the industry. They've built clear rules and they've got bank charters. They've chartered a couple of banks already. Yep. And really, certainty is really what they're looking for, right? Regulatory certainty. Of course, hopefully some reasonable rules as well. But in the end, just give us any rules. Let's give us the rules and let's figure out how to do this in the context of, because we don't want, basically, to use an industry term, the rug pulled out from under us after we've invested in building a very invested in building a business, and then all of a sudden you change the rules at the 11th hour, and I can't launch my business anymore, or I can't support my business anymore. So really clear rules, and I think the FINMA, the MAS in Singapore, as you mentioned, BaFin, they've got clear registration requirements, they have clear information requests, they have clear permissibility standards. Right. Some of them are a little bit more restrictive than others. Like people would argue, MAS is a little bit more risk averse, and Switzerland is a little bit more. That they'll allow a little bit more. Really, all of that depends on. That's a dynamic in any and every day, right? If I think about like what are some of the areas that actually contribute to the risk appetite of of digital assets custody solutions. It is, in some ways, it is the design and the controls, right? Because that's the foundation. But the other piece is what assets do you actually support and which ones don't you support? And that really contributes to, there's thousands and thousands of tokens out there. And those tokens have very different attributes in terms of whether they lend themselves to the appropriate level of financial crimes compliance, what the governance structures are, whether they should be considered a security or not. Are they a fraud or not a fraud? So in supporting custody or trading or lending of those activities, you are scaling up or scaling down your risk appetite. That's an area that I think regulators are beginning to understand. And one of the things that the federal regulators asked us about very early on, how do you make a decision on which token you're going to support and which ones you're not going to support? And that, I think, will be a really interesting evolving process.
So clearly that's still a challenge. How do you think firms are going to look at going one step beyond that and looking at DeFi or even as far as DAOs? Is there a framework they can start thinking about that actually could get them involved?
I think it's very interesting. DeFi is very interesting because DeFi is essentially, going back to coin due diligence, it's a token, right? So you have to dissect the different parts of that token. How is it established? What is the underlying activity? What is the governance behind it? Does that give you a certain level of comfort that these activities can be performed in some way? I think that the idea that DeFi or DAOs are somehow going to live outside of the regulatory perimeter, as long as they're performing activities that are otherwise supervised or regulated, that's not going to happen in any level of scale. If you're facilitating trading, eventually you will have to apply to be a broker-dealer or to have some other form of registration that will require you, because you're performing those activities. And there's certain level of consumer and regulation that needs and protections that need to be in place in that sense as well. In terms of DAOs, the Wyoming law is a really interesting one because it actually allows DAOs to become LLCs. What's interesting about, I think, the Constitution DAO got it on everybody's front page to how is it that someone people raised $40 million in 6 days and came within $1 of probably the execution wasn't the best, but an illustration of the power of that technology. And I think what's interesting about where they're looking at where were the faults, and may have been in the governance. And that really is the central part. That's the centralized part of the DAO that I think you're never going to lose if you're operating in a regulated space, because there needs to be a throat to choke. There needs to be someone to keep accountable for maintaining these standards. And so there has to be some basic level of centralization within the DAO, even if most of the activities are performed in a decentralized way.
Absolutely. We've had the same discussions here. I mean, do you see other states or other jurisdictions embracing similar regulations around DAOs that Wyoming has?
I hope so. I hope that we see something like that at the federal level soon. So hopefully.
That would be exciting. Well, as I expected, we're almost effectively out of time. So we will have to have you back and dive into a lot of these subjects more deeply, because I think we've only scratched the surface. But Julian, it's been a real pleasure having you here, and thanks for your time. Anything else you would like to wrap up with before we cut it?
No, just thank you very much for your time, Seamus. It was a pleasure as always, and I look forward to talking again soon.
Thanks, Julian. So this was unfortunately, this is the last episode of 2021. The good news is we'll be back in 2022. So on behalf of everyone at METACO, thank you for joining us. Thanks for your support this year, and all the best for the holidays, and see you in 2022. Thank you. Bye. Thanks, Julian.
Thank you.